All right. Hello, everyone, and welcome to our monthly webinar. I am Justin Cooper with Pine Financial Group. I am a senior loan officer here at Pine Financial Group, and in addition to being a hard money lender, which is what Pine Financial does, I'm also a full-time real estate investor. I own a small handful of rental properties. I've done new construction. I've done fix and flips. I've even done some more creative stuff using my self-directed IRA. Um, and Pine Financial Group, as I just mentioned, is Colorado and Minnesota's premier hard money lender. So if you have any questions on hard money, how it works, how you might be able to use it, whether you're a newer investor, a seasoned investor, whether you're a cash buyer, or someone who's scraping together a couple bucks and just trying to get your wholesaling career started, we're happy to help you. There might be more ways than you know that a hard money lender might be able to work with you. And if not, we've got 1,000 loans under our belt in experience. So maybe just a nice chat and catch up, and maybe we can offer some advice. But in addition to being a hard money lender, and of course doing these webinars, Pine Financial Group also hosts several other events each month. We host classes at different locations at different times throughout the month. We also host a monthly networking and educational happy hour. And actually, perfect timing, we have 2 real estate investor success summits coming up. So the one in Colorado, if you're in Colorado, is coming up very soon, October 15th. It's going to be a Saturday. It's a full-day event. We're expecting probably 300 to 500 investors. We'll have close to 20 vendors. We've got 8 speakers, a keynote, a panel. It's going to be an amazing event. If you're interested and want to come, please go to our website. It's denveriss.com. That's the website specifically for the event. If you want just more information about Pine Financial, you go to pinefinancialgroup.com. And if you're in Minnesota, we've got the Minnesota Real Estate Investor Success Summit coming up in early November. And I believe the website to register for that would be mniss.com. So tonight on our webinar, and if you've noticed over the past several months, what we do is we like to cover a variety of topics. What we do is we bring in our friends in the industry to share their expertise. We may or may not record each event, so it's important for you to register and sign in early so you don't miss anything. You'll also have the opportunity to ask us questions live on the webinar, and we do our best to answer each and every one of you. I also want to say thank you to everyone who's made it on tonight's event. We know that you're giving up some of your time, so Greg and I will do everything we can to bring you the value you're hoping for. Tonight should be easy since we're talking about a very relevant topic, title insurance. Now, whether you know it or not, every time you buy or sell a property, be it a flip, a rental, or your personal use, there are title companies involved, and they're much more than just a place you go to sign papers. Tonight, Greg will be going over some of what a title company does in order to get everything behind the scenes ready for closing day, and also give you some tips and tricks to keep in mind and request on your next transaction. I feel fortunate to be introducing Greg Parham. Greg is a co-founder and manager of First Alliance Title, a title insurance and escrow company serving the entire Colorado Front Range. Since 1994, Greg has practiced in private practice as well as general counsel for a multi-stage mortgage banking firm. First Alliance Title is the second of 2 successful title ventures founded by Greg. In 2002, he founded Vista Title and operated that company until selling it in 2009. In addition to the title and legal work, Greg is a licensed real estate broker. Greg is also a frequent lecturer on matters pertaining to residential and commercial real estate, including foreclosure laws, real estate contracting, seller finance, short sale transactions, landlord-tenant matters, and the structuring of complex real estate transactions. Greg, I gave him just a little taste about who you are and what you do. So before we get it started on tonight's topic, why don't you give us a little bit more background on you and then dive right in.
Oh boy, I'm telling you, thanks for having me, Justin. I think you summed it up. Is there anything more to tell, like another job that I need to have or something?
I don't know. I think I saw somewhere you like to ski. I know we've just started getting snow up in the mountains here this week.
Oh boy, love skiing. Still tribal soccer, and then trying to keep up with our kids. So yeah, that's I'll tell you what, the real estate business in Colorado is enough to keep you busy. That's for sure.
Absolutely.
Very busy, and I will do a shout out real quick for your Investor Success Summit coming up. We go to that every year. It's fantastic. It's the best event of any organization in Colorado for really high content stuff that nobody's trying to sell you on the back end or anything like that. Lon Welsh is going to be there for us doing a fix and flip analysis on the trends for that, I believe, this year. So really looking forward to that.
Oh, thank you. Yeah, Lon's going to be there, and he always does a great job. He's going to have a ton of information. It's going to be great.
Yeah, yeah. Well, you guys want to get started into title insurance?
Let's do it.
I guess so. Let's do it. So, you know, it's funny. I was talking to you about doing this presentation, and I thought, well, maybe we should do it late at night because title insurance might be a good way to put everybody to sleep. But for those of you tuning in, I hope most of you are in Colorado, which means you're avoiding your drive time right now, which is nice. So this is great for me because I can do this presentation and then we can head home. So let me kind of see if I can get my little. Whoop, there it goes. It's working. So let's talk about title insurance. So, you know, I've tried to present these questions in a whole bunch of different ways. And at this point, I think the best way for me to be able to explain what title insurance is to put you in the shoes of a buyer and a seller. So let's pretend here, I've got on the screen this sale of 123 Main Street, and Sally's selling her house. Barry Buyer's buying it, and he's going to fix it up and he's going to hold it as a rental. Pine Financial, lo and behold, is going to do the lending, and they're going to help him buy the property and then do the rehab loan as well. So you got to ask yourself, if you're Barry, what concerns would you have about the title? You know, what issues are out there? And that's what we've referred to as the owner's title insurance. When there's a real estate transaction that involves a loan, there's two policies of insurance. There's an owner's title policy of insurance that insures the owner, and then there's a lender's policy that insures the lender. So, I know there are people tuning in from other states as well, so the rules will be different on what types of things attach to title and that kind of thing. But generally, it's all very uniform. So the buyer, for instance, Barry Buyer, he wants to be sure of a few things. Does the Sally seller have a judgment that might be against her? Are all her loans going to be paid off? Because her lender's is using her house as collateral. We need to make sure those deeds of trust are released. Are there any unpaid taxes that need to be worried about? And then easements and boundary issues. Those can be really significant in certain areas where the easements or where the boundaries are kind of hard to determine. And fraud and forgery, that's one that a lot of people don't really know about. Let me give you an example of fraud and forgery. Let's say that Sally's owned this house for a long time. She's an out-of-state owner. And some horrible person realizes she's an out-of-state owner, and that person pulls up her old deed and her deed of trust, and they're really good at copying her signature. And they create a new warranty deed to themselves, and they write her name in it, and they have it recorded. So they forged her name, and they committed fraud by doing that. And now they're listing the property for sale. She doesn't know about it because she's on the beach in Australia or something. And they sell it. And this other person pretends to be Sally and signs all the documents at closing. And the new buyer has the property, and they're in there fixing it up. And then Sally comes home from Australia and says, "Hey, what are you doing on my house?" So it's kind of a horrible scenario, but those are the types of things that title insurance can protect against for fraud. So another one is HOA restrictions. So remember, we talked about Barry wanting to buy this property to rent it. Well, what if the homeowners association or the condo association doesn't allow rentals? If Barry hasn't been provided with the condo declarations and all that stuff on title that shows all the rules and restrictions, he might just buy that property, and then he's stuck with fixing up a property that he thought he could rent, and then he can't. It's kind of a problem. Another one I have up here is mechanics liens when you don't pay a supplier or material person. They can lien the property. Those are kind of various concerns, so you might want to ask, well, what's Pine Financial's concerns? Well, it's the same stuff. Pine wants to make sure that all those things are protected against, but Pine also wants to make sure that they are in what's called first lien position. That means if this property goes into foreclosure because the borrower doesn't pay Pine the promissory note, then Pine's going to be able to go in and foreclose on that property. And they want to make sure that their lien is the first lien so that when they foreclose, they are the owner without any other lien holders laying claim to that title. So it's interesting, title insurance as a whole, the lender's policies are probably the ones that are utilized the most, and they're usually utilized in times of kind of financial distress where a bunch of properties are going into foreclosure, and then we start discovering these problems with the title because the lender is foreclosing.
Yeah, we've actually had to file some insurance claims a couple times, not necessarily for those reasons, but it's amazing. Little things that may come up and what's gone on and the fact that we have to use this, but really anytime you use any kind of insurance, it's there for a worst case type scenario. And it's always great once you actually start using it to find out how important it is to actually have that insurance.
Yeah, I sell title insurance, so I'm always telling people to buy it, of course. But I will tell you, I had an investor. We used to do a lot of transactions with HUD, and we would handle the closings for HUD. You know, a lot of investors would buy these properties, and we had an investor that said, I don't want to pay for it. And I said, okay. So at closing, I make them sign this document that says, I don't want title insurance. You know, I understand that I'm going to be liable for anything on title, blah, 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 blah. And he asked me, he said, well, is it clean, the title? And I said, I don't know, because you didn't get title insurance, so I didn't underwrite it.
Yeah.
You know, it's kind of
exactly.
like buying. It's kind of like buying a house with a really beat up roof, and going to your insurance guy, your hazard insurance carrier, and saying, hey, I don't want you to insure this roof, but can you just tell me that everything's good? You know, and I won't have a problem. So it's kind of like that. And lo and behold, this guy had a HOA, outstanding HOA that hadn't been paid. And I think he eventually got the seller to pay it, but caused him some problems, because I remember him calling back later saying, hey, I've got this title problem. And I said, yeah, you do have a title problem. I don't.
Yeah. I mean, and similarly, when something like this comes up and now this guy had to go and fight the seller, you you are an attorney, and title companies have attorneys and people who do this stuff all day, every day. These are the battles that they fight, and they know how to fight these battles. So, I mean, it always hurts sometimes when you see the cost of these things, as large or as small as any kind of insurance premium might be, but knowing that you have all these people double checking things and the attorneys that they have to fight on your behalf, I think is really super important. You know, hopefully you never ever have to use any of that stuff, but knowing that you have it there just in case is really, I think, for me, helps me sleep at night sometimes.
Yeah, yeah. Let me talk about a couple of other differences, because title insurance is really different than typical casualty insurance, you know, property or casualty insurance. So title insurance, you get paid at closing. Like, you pay it at closing. It's a one-time premium that somebody pays at closing. Now, in Colorado, customarily, the seller will pay for it, but it kind of depends on the market. You know, we're in a huge seller's market right now, so sometimes the seller's passing that on to the buyer because it is the protection to the buyer. So they're like, well, if you want title insurance, pay for it. But, you know, so it's a negotiable thing in Colorado. In other states, they have different traditions, but it's a one-time premium that someone pays, and you're insured as long as you own the home. So, you know, if you get a title claim that comes up, you know, 50 years down the road, your title insurance company is going to have to insure it. The other really strange thing about it, in a way, is title insurance insures against things that happened in the past versus in the future. So, for example, if I'm
Yeah,
insuring your house,
Greg, are you typing over there as you're giving the presentation?
I'm not typing.
Is somebody in your
Yeah.
office typing? I can definitely hear somebody typing, and I think some people on the line. If you're on the line and you have any question of any kind, feel free and just go into that question section and jot it down, and we'll be asking Greg. But yeah, Greg, we definitely hear somebody typing or something like typing on the line.
Yeah, that I've been hearing it too. You know what I think is a lot. The link that I sent out, I think I sent out a panelist link, so it probably has a lot of these people's microphones enabled. Uh, you might need to mute them.
Interesting. All right, maybe
Yeah.
I'll let me play around to see what I can do there.
Okay. So, so one of the things I was talking about is title insurance insures things kind of behind. So, for example, when you buy a property, let's say you buy a property October 4th, things that impact title in the future could be things like, you know, you didn't pay your credit card and they got a judgment against you, and that is a lien on your title, or you get a new loan on your property, and that you know you get a loan on your title. Those things aren't covered because they're things that are happening in the future that are either voluntary liens that you're allowing or involuntary liens because you didn't pay taxes or whatever. So it's really insuring the things in the past. So if some previous owner, like let's take Sally's example where she went to Australia, you know, that is a situation where she comes back to her property and she says, hey, get out of my property. And that new buyer who got title insurance, the title company is going to have to defend that claim against her because it's you know, this is something that she took title in the past. So that the same respect with easements, encumbrances, all kinds of things. It's kind of a backwards insuring policy. What's unique about that is we have the benefit of entirely underwriting a file, and I'm going to get into the search process later. But you know, we do our underwriting of a liability prior to something happening, where a lot of other insurance, it's kind of built upon, you know, odds of a risk happening, odds of the hailstorm coming next year to damage the roof, etc. So it's a very different thing with title insurance. And that underwriting piece allows us to find things that has happened in the past that need to be corrected. And then we correct them prior to the new owner taking title or at the closing, so that the title moving forward for the next person, the next person, the next person is cleaner and cleaner and cleaner. So we like to, in the title industry, when we're kind of feeling happy about ourselves, feel like we really do keep the title records straight and clean because we're always fixing you know, minor issues that have happened in the past. And if you weren't getting title insurance, you wouldn't see them until you got a really major problem. That's kind of differences between title insurance and casualty. I think the keyboard seems to have helped. So.
Yeah, I think some people absolutely checked in under that super secret code you sent out, and I think I tracked him down and muted him. So we shouldn't hear from him, at least not you know, audibly anymore. So
sorry, folks.
learning
All right,
curve. We're still new at this thing.
Let's talk about the process here. So the first thing we would do when we get title insurance or a request for title insurance is it's when we get a contract or a request for a loan, like a refinance or something. So we search the property. We go back and we want to find out who the current owner is, and then we want to go back and find out who that previous owner is, and then the previous owner, at least that far back, so that we can track multiple owners to make sure all the deeds look correct. You know, they're all properly signed, notarized, legal descriptions are correct, etc. And that everybody that's in that chain of title has passed the title on to the next person, so on and so on. And then we identify any problems that we need to fix. We fix them either in advance or at the closing table, and then we close it, close the deal. That's kind of the escrow side. That's pretty much what we do in a nutshell. Let me give you a kind of a breakdown of the chain of title so people kind of understand these issues. This is a pretend title here, chain of title, where in 1970 I have a warranty deed from this home builder to Clive Jones. And then in 85, I've got a warranty deed from Clive to John Smith. And then in 95, John Smith sells the property to Sally Seller and Stephen Seller. So in our scenario that we've been talking about with Sally Seller and Barry Buyer, I didn't mention a Stephen. And so I'm kind of pretending what happens a lot, in fact, that I've got a contract that has Sally Seller is the seller and Barry Buyer is the buyer. And we pull the title and we say, wait a minute, we're seeing two owners here. So then we have to determine, okay, well, what's up with Stephen? And there's usually a couple of likely scenarios. One is they got a divorce and they forgot to sign on the quitclaim deed to get the property in Sally's name, or Stephen died. And if Stephen died, then we have to determine, well, what kind of deed did they have? Did they have a joint tenancy deed where Sally would be the surviving spouse and therefore the owner? Or are we going to have to probate Stephen's estate because it's a tenants in common deed? So that's the kind of stuff we learn from the chain of title. And the chain of title also gives us a lot of information, like whether there was a fraud that was kind of obvious involved.
And what if it's something as easy as Sally just signed the contract on her own, and Steve wasn't a part of it, but they're still alive and they're still married? Is that just a simple amendment to correct that or something?
Yep. Yeah, then we'd say, hey, and that's usually what we'll do is we will require we'll require an amendment to add Stephen to the contract, and then we might get a call from the listing agent that says, hey, Stephen's dead. So then we need to go back and figure out, okay, how did they take title, and is this now her property? And if it is, we just need to file a death certificate to clean up the chain of title.
Gotcha.
Those are the kind of things we're looking at. So the other thing we look at is like encumbrances. So encumbrances could be easements for utilities, HOA restrictions. I talked about HOA restrictions with respect to rental units. That's a very important one as an investor. Believe me, I've seen this happen 3 different times now, where an investor fixed up a rental to flip it or to rent it and could not rent it and didn't know that beforehand. So you investors out there, make sure you do your homework on that. This encumbrance, we have a sample here of Sally and Stephen. They got a mortgage from ABC Bank, and so that would be an encumbrance that's on title. And their 2015 taxes, if they hadn't been paid, that'll be on title. And then we'll pretend that Stephen Seller had a judgment against him for $10,000.
So these encumbrances, are these part of those problems that you talked about on the previous screen?
Well, sometimes they can be problems, and sometimes they're things that aren't going to go away, but you just need to be aware of what they say. For example, the easement. There's probably an easement on a property, and it's okay if there's an easement for the utilities. You just might need to know that where it is so that you can determine whether you can, for example, expand the square footage on a fix and flip on one direction on the lot without running into approval problems because you're encroaching on the city's easement.
Gotcha.
Or knowing that if you do encroach on that easement and they have to come up and dig up their gas line, they're going to remove part of your house.
Yeah.
So that's kind of important to know up front.
Absolutely.
So we look at the chain of title, we look at the encumbrances, and then we prepare a title commitment. And all the title commitment is it's exactly what it says. It's a commitment to provide a title policy in the future. So the sequence of events goes like this. You go into contract, we do the title.
Greg, sorry to jump in. Somebody had a question about what you had just talked about. Say with that HOA, said, what if that house can't be rented? Is that something that the title insurance can jump in and help with?
No, because what I'll show you here is there are certain things we will cover, and there's certain things we won't. An HOA declaration is something that's already recorded against the property. So we are basically just like an easement. So we're saying, hey, property owner, we're gonna insure your title, but there are some things here that we can't insure over because they're already of record. For example, you're going to have to comply with all your HOA declarations because by moving into that neighborhood, you are saying you will agree to do those things. And one of them is you can't rent that property. So no, that is one that we wouldn't be able to help them with. Now, if we didn't have that exception on our title policy, let's say there was an HOA and we completely missed all those covenants and restrictions and everything, and then that came up, yeah, they'd probably have a title claim, and we'd have to give them probably the difference between the market value of that property as a rental and not as a rental. So
Interesting.
yeah,
So because you put it on the title commitment saying, hey, there's an HOA, something that you need to be aware of, now it's up to the buyer to say, okay, well, the title company told me about this. I should now read and review it and understand what I can and cannot do.
That's right. And in a typical real estate contract, you're going to have the ability to, there'll be a deadline for receiving all the title work, and then you're reviewing it and objecting to it. And in Colorado, you can object and basically say, you know what, I'm going to terminate because I can't get this as a rental. It's the only reason I wanted to buy it. I'm going to terminate the contract and get my earnest money back.
Yeah.
So when after we do that search, we prepare the title commitment, which basically does what we've been talking about, where we identify who's going to be the insured, what requirements are we going to need to jump through to maybe fix problems, or in other words, just provide clean title, and what exceptions are on the title are going to be on the policy. So for example, that HOA stuff, it's already there, it's going to be exception to our policy. So we're basically committing to insure, telling you what's going to be required to issue the policy and what's always going to be an exception on the policy even when it's issued. So it's kind of, when you're dealing with homeowners insurance, you might get a quote from your insurance provider before you buy a property that says, hey, this is how much my insurance is going to cost. But you might not get a full-blown binder where they're showing you this is what the policy is going to look like when we do bind coverage. That's kind of what a title commitment is. In some states, they actually call it a title binder for the policy. So let me just run through. This is kind of where you can kind of like stick a needle in your eye if you need to wake up, because this gets a little dry. But it's important to go through the title commitment because as a real estate investor, you need to know where these things are and what key things to look at. So there's a whole bunch you can look at, but I'm going to kind of identify the key things to look at because you kind of know it. And the good news is if you're in other states, the forms are very similar because we all follow the American Land Title Association forms. And that enables us to be able to review a title commitment in one state and see the same issues as if we reviewed it in another state because it's formatted all the same way, at least generally. So, on the screen you'll see the who and what, Schedule A, and then there's Schedule B1 and then Schedule B2. I guess they just like schedules, and that's what it, instead of just saying the insureds and the requirements and the exceptions, we have to have schedules for those things. So here's the schedules. Schedule A, this shows your who's going to be the insured, and you'll see buyer name up there at paragraph 2A. It shows that there's a mortgage company that's going to be an insured, and it shows what endorsements you might get on the title, and I'll talk about those in a few minutes. And if you look at number 3, it shows who the seller is and how they're vested in title. That can be important because if number 3 said Sally seller and Stephen seller, you'd know right away that you only went into contract with Sally, so something's going on. We need to figure out what the deal is with Stephen. So Schedule A is the who and what. Schedule B is the requirements. So you'll notice in title commitments there's a whole list of requirements, and most of them are standard for every single transaction almost. And then there are more specialized requirements due to the state of the chain of title. So for this one, for example, we had that loan out there that Sally had taken out. And so we're going to need to release that deed of trust. We're going to have to pay off that loan. So that's a requirement. We take care of that payoff at closing, but so the policy that's going to be issued to the buyer won't have any exceptions for this deed of trust because it's going to be paid off. So we have to pay it off in order to give Barry clean title. So you may see other requirements. Here's a couple common ones. So maybe there was this judgment against the seller. we would need to have a certificate of satisfaction that that judgment's no longer out there. There might be a lien filed by the HOA, and we would need to have that lien paid off and released. So you'll see those types of things as well. Let me give you a little tidbit in Colorado too. This is, I'm not sure how widespread this is in other states. Judgments in Colorado are not recorded really against a specific property. What happens is when somebody gets a judgment against you, they go back to the court clerk and they say, we need a transcript of judgment, which is just a summary of the judgment. And then they record that summary of the judgment in county property records. And they might record it in all Front Range counties or all counties in Colorado even. Once they record that, let's say it was legitimate judgment against, Sally Seller. Once they record that judgment becomes a lien on every property that Sally owns in that county where it's recorded. And also any property that she acquires in the future in that county. So to flip it around, you'll have a buyer sometimes that has judgments against them. And so they might not have any property that they own, any real estate that they own. But as soon as they buy that property, if there's a transcript of judgment recorded in the county where the property is located, it will immediately attach to the title. So the buyer can buy it, no problem, but then when they turn around and sell it, they're going to have to pay off that judgment. So we always search the buyer side and the seller side like that. So sometimes you guys with common names out there, you'll see those come up, like John Smith. You'll see those come up, and most of the time it's the wrong John Smith when it's a common name like that. And we do go through and verify, okay, is this really our John Smith or not? And we can eliminate those requirements. And then the last schedule, the Schedule B2, are the exceptions. This would be an example of the homeowners association, for example. If you take a look at number 9 down there, it says easements, notes, terms, conditions, provisions, restrictions, covenants, et cetera, it talks about a plat that was recorded. So if that plat has an easement in the back of each yard of, each property line of an 8-foot easement, then, your title policy won't cover your use, your exclusive use of that 8 feet in your property because it's an exception to the title policy that's going to be issued. Other exceptions are the homeowners association exception, like we talked about. Okay, so when you look at a title policy, I'm going to go back to these exceptions here. Exceptions to coverage is never a good thing when you're talking to an insured. They don't want exceptions, right? They don't want exceptions or exclusions. And look at all these exceptions. Look how common some of these are. Like number 3, discrepancies, conflicts, and boundary lines, encroachments. That's an exception. We don't insure it unless you get an endorsement to cover it. And number 4, any lien or right to a lien for services, labor, or material. That's mechanics liens. So we don't normally insure that unless somebody wants an endorsement to cover it. So in Colorado and many other states, that's where the owner's extended coverage endorsement comes from. That endorsement provides you greater coverage because it removes some of these exceptions, the most common ones, like parties in possession, recorded easements, boundary issues, and mechanics liens. In Colorado, there's a section of the contract where it allows you to decide, do I want owner's extended coverage? And you always choose yes, because it's like $50 and it provides a huge amount of protection. And so that's what people mean by owner's extended coverage. And this just highlights, this slide, some of those exceptions that are actually would be deleted with the owner's extended coverage. So it really reduces your coverage lower. You'll notice there's number 6 is remaining, mining claims, etc. So we could do another endorsement to remove mining claims. and it just takes additional fees because we have to do additional research on them usually.
So, especially in Colorado right now, with the fracking and the drilling and stuff, how often are you seeing this come up, especially the one specifically on mineral rights, or how much are you seeing discrepancies with that?
Well, a lot of people, it seems to be on everybody's mind, right? So they're questioning things that they come up with some questions on, like, hey, do I need to be worried about this? Where years ago they didn't, because nobody was mining and the close suburban areas. It was always thought, oh, that just happens way out in the boonies. But the boonies are now closer to town. So,
Yeah.
and the mining and the extraction of minerals has gotten a lot heavier. So there's two things to think about when you talk about mining and mineral rights. There are surface rights and there's subsurface rights. And subsurface rights are just the ability of a mining company to come in and extract minerals and including gas below the ground. That doesn't impact your property whatsoever. So, let's say you're my next door neighbor and we both own 100 acres. And if I own the mineral rights under your lot, I could have somebody drill on my lot and then go down and tap into, whatever your aquifer was down there or whatever it was, and be able to do that. And then there's surface rights, which allows you to actually, I can drive the rig onto your property and disturb the surface of your property. Most of the places in Colorado, especially closer to town, they don't have surface rights. So people get concerned when they see a mining or an oil and gas lease or something like that that's on title, because they think that the rig is going to come and start digging up their lot, and it's not. Those are usually not to be concerned about. And the fact of the matter is, those have probably been sold to oil companies left and right and leased, and the person that's selling you the house probably doesn't have rights to those subsurface minerals anymore. But it's definitely an awareness thing. And if you are in an area where there's active mining, yeah, you probably should take a look at it. And if you think you have a property where you're going to sell your mineral rights to somebody else or retain them to lease them, then you probably need to get an oil and gas attorney involved, because they can be very valuable depending on where you're at.
Yeah, that makes a lot of sense. Before we move on, can we talk a little bit more about the mechanics liens? And
Yeah.
specifically, are you talking about ones that might come if we're going to do a fix and flip? Are you insuring on things coming in the future or things in the past, or what does that look like?
Yeah, mechanics liens are a special lien. They have what's called super priority. So that means, let's say Justin's selling me his house, and we're closing on October 4th, but you had a painter come out to your house last month, and that painter completed the job, and then we went to closing, and you never paid the painter, or maybe you paid the painter what you thought the painter deserved, but you were in this dispute, So what can happen is that painter can now file what's called a mechanics lien. There are some time requirements. They have to file it, within a few months of the work being completed. But once they file it, it can be a lien on that property, and then if you continue to not pay them, they can actually foreclose on that lien. And the really sticky part about it is, it doesn't just it's a super priority lien because it jumps forward from actually backward from the date of its recording. It relates back to when the work was done. So now that you've sold the property to me, then all of a sudden I get this notice that says there's this mechanics lien and they're going to foreclose, and I'm like, wait a minute, I'm the owner of this property, not Justin. Well, that's what a mechanics lien does. It gives you the power to do that as a contractor. So it's very prevalent in fix and flip type cases. We want to know that everything's been paid when you are doing a fix and flip. You'll sign an affidavit that says there's no outstanding work, everything's been paid. And in some circumstances, the title company is going to make you show the budget and show the receipts to show that everything's been done. Then what the title company does is it provides mechanics lien coverage. So if that lien were to happen, the title insurance company would defend me against that mechanics lien by that painter. In this case, what would probably happen is the title company would defend it, but then they'd probably say to Justin, hey, remember when you signed that affidavit that everything was paid? Well, you need to pay it now, or we're going to sue you. So very mechanics lien waiver. It's very important for lenders too, because that lien can jump ahead of the lender's deed of trust, and the lender would not like that, because then if they foreclosed, there'd still be this lien in front of them. Great question. Let me, I'm gonna dig a little bit deeper with mechanics liens, because I know this issue comes up with a lot of fix and flippers. Every once in a while, as a fix and flipper, you're going to be held hostage by your contractor, who says you owe more money than you do. And they know that you can't sell that property until you pay them because of the threat of a lien. So Colorado has a nice mechanism to get around that. It's a statute that allows us to escrow 1.5 times the lien amount, and then we can go ahead and close, provide insurance to the new buyer, and then if that lien holder brings the foreclosure lawsuit after filing the lien, we just deposit the money with the court, and you and the contractor can fight it out then, but the lien is released from the title. So it just becomes this dispute over the money, but the title's not involved anymore. It's a great way to take the leverage right away from the contractor if you can afford to escrow 1.5 times. And the good news is you only have to escrow that for 13 months from the date of filing of the lien. So let's say you're halfway through your project, there's been a lien filed for a couple of months. Now we escrow 1.5 times. We only have to escrow that for another 11 months. And then we get to return all the money to you. Hope that makes sense. That comes up a lot. We're pretty, I've done those escrow agreements a lot. And so if you ever have a question about that, feel free to reach out to me and I can help you with that.
Yeah, that's a great tip. And like you said, that's specifically for Colorado. So anybody outside of Colorado, definitely something you should be talking to your title company about, making sure they understand it or they see what might be available where you are, if that's something they can help with.
All right, now let's say you're in a transaction, you get your title commitment. What do you do with it? What do you look at? So these are the 4 things that you're really going to take a look at. You want to make sure the buyer and seller's right on the title commitment, that's Schedule A. You want to make sure that if you've gotten an owner's extended coverage endorsement, that they're showing that you're going to get it. You need to know who owns the property right now, because maybe Sally owns it with Stephen. And you need to know whether there's any ordinary or extraordinary requirements or exceptions in the title. For example, if there are HOA covenants, you need to read them to make sure there's no restriction on the rentals that we've been talking about. So this is where you look for those things on the title commitment. So I've got the buyer name circled and the seller vesting circled. And then on the requirements page, I've got that one main requirement that we talked about on there. That would be a special requirement, where all the other ones are just general requirements that are going to be on every single commitment. And then the exceptions. So you want to take a look at any special exceptions like number 9 there, so that you could make sure that you are good to go with that restriction on your property. So as you guys are marching through your closing process, the title company is responsible for making sure, lienable things have been paid off. HOAs are lienable, water is lienable, sewer is lienable in most municipalities, and taxes are lienable. So we kind of hunt all those balances down, and we start doing prorations between the buyers and the sellers, and we create the settlement statements that everybody eventually closes on. So I'm going to go over a couple of things on settlement statements that I think are the most common questions that I get from sellers, so that hopefully you can figure out why this is the case. So this is a seller's settlement statement. Everything the seller's getting credit for is on the right-hand side, and everything they're getting debited on the left-hand side. So for example, the contract purchase price of $140,000, they're getting a credit for that. 2 things that I've circled. One is the payoff. So you'll notice there on the payoff, we always collect additional interest, and everybody's mortgage statement is different than the actual payoff, because the mortgage statement doesn't include the interest for the last month, the last 30 days, and we always pay interest in arrears with a loan. And so you can usually take a mortgage statement, whatever your principal balance is, add 30 days of interest to it, and then you're getting to what you're really going to owe. And then the lender has some fees as well. And then the title company is also going to tack on a few extra days after the closing of accrued interest. Now you as the seller will get all that money back for any overage that's sent. But the reason we tack it on there is so that if our wire goes out, it's rejected for some reason, we can still wire it out the next day, and the money, and it still pays off the loan because it's important to pay it off. So the other thing I have on here is the water and sewer. So for example, in this case, we always escrow for the final water bill, meaning we collect this $175 in this case from the seller, and we then order the final water bill to be read as of the date of closing. And then the Aurora Water, in this case, sends us the bill. We pay out of that escrow balance the seller's last bill, and then we refund the seller the difference. So those are two items that always come up as like, hey, what the heck is this, you know? And then on the buy side, I'll kind of back up here a little bit. There are prorations that are done between the buyer and the seller for things that maybe the seller paid in advance. And so now, since it's been paid an entire year in advance, the buyer at closing has to, you know, give the seller a little bit of money because they're going to be benefiting from that, and the other way around as well. So the big one in Colorado is taxes are paid in arrears, meaning 2016 taxes for property taxes will be paid in 2017. So if we close this year, like right now, I can't give you a tax bill because the treasurer hasn't issued them yet. So what we have to do is we figure out what the tax bill is, and we prorate it to come up with the per day amount, and then the buyer gets a credit from January to the closing date because the buyer is ultimately going to pay the entire year of taxes next year. So I've got a little illustration here on this slide showing you that, for example, this is a pretend closing in July, July 2nd. So we'd be prorating taxes from January to July 2nd, and that's how that would work. This slide's just another example of how some of those prepaids go back and forth. And I won't spend much time on this because you'll really get sick to your stomach. This is the new closing disclosure form that you guys have probably heard of TRID. Well, certain loans, there's this new disclosure that the feds require, and this is what it looks like now. Very easy to read from a buyer's perspective, and that's what it's supposed to do. And the seller has one of these too. So all it is different, same numbers, different forms, different way of disclosing things. So in this case here, you look down at the bottom and you say, okay, the buyer has to bring $14,000 to closing. And then there's more pages of all the other detail of back and forth that I won't bore you with.
Yeah, I mean, when somebody's going to closing and they get one of these settlement statements, if they have questions, they should just be calling the title company, calling their closer, and asking more questions and more details, because of course it's going to be now more specific to their property and their deal, so it'll be much more relevant to them.
Yeah, it's a great question. So let me break that down a little bit, though. If you're somebody that receives this and you're getting a loan from Pine, for example, and you see a loan charge on the settlement statement that you don't understand, if you call the title company's going to go, call Justin, because we just regurgitated what he gave us, to put in there on the form. So some of that stuff you do have to go to the person that's providing it. I always tell conventional buyers that they're going to get this closing disclosure form. It's a really detailed one, and this is generated usually after everybody's had their input, the realtors, the mortgage broker, etc. And so a really good source for those questions at this stage is going to your lender and saying, hey, I don't understand item such and such. But you can also call the title company, and we'll tell you exactly where we got it, especially prorations and things like that, payoffs, any of that stuff, definitely contact us, and we'll tell you where we came up with the numbers.
Yeah, and really anybody involved in the transaction, the lenders, the agents, everybody should be wanting to explain this to you and make sure everybody's on the same page and upfront about their fees and where the numbers all came from. Make sure you understand before closing what you're being charged.
Yeah. Let me talk about quickly here a couple of different types of discounts that title insurance has, and you're going to have these at different rates, different amount of discount depending on your location. In fact, some states, it's interesting, the state mandates rates. They just give, this is what the insurance rates are, period. In Colorado, we have a couple of discounts that are very prevalent. One is called a reissue rate, and that is a discounted rate when the property has recently been insured, so insured by title. So for example, if you just bought your property 2 years ago, we're assuming that title company actually did some research before they insured it. So the risk to us in reinsuring it is a lot less than if we were taking your property and insuring it and it hadn't been insured for 20 years, or 30 years. So that rate usually applies for 2 to 3 years. Some underwriters, like our underwriter, allows you a 6-year reissue rate, but then they stagger the discount. So if you've refinanced or bought your property and had title insurance on it within the last couple of years, you'll usually get a 50% discount on your base rate. Now, if you're into the 4th or 5th or 6th year, that discount might change to 20, 30 or 20 or whatever the year is. But a reissue rate is something you need to make sure when you're getting title insurance. If you're buying it, say, hey, am I getting the reissue rate? Does it apply here? It's really important.
Yeah, this is something they should be bringing up and asking for, right? It's not just automatically going to be applied or given.
That's right. That's right. The other big one here is hold opens. A hold open policy is used in fix and flip scenarios. So what you're doing there, if I am buying a property as a fix and flip, I can get title insurance for myself, or I can get a title commitment that then holds the policy open for the subsequent purchaser that I'm going to resell to. That way, I'm only paying, there's only one premium that's going to be paid versus 2 separate closings with 2 separate premiums. So here's how it kind of works, and they're commonly known in Colorado as 110% hold opens. So let's pretend we are, and this is a pretty good deal depending on how much money we put into it. We bought a property for $250,000 and we're reselling it for $390,000. So without a hold open, look at the left-hand side of this column. The first closing, the title policy is going to cost us about $1,313, and that's assuming there's no reissue rate. The second closing is going to cost us another $779. We get a slight discount there because of the reissue. Actually, get a 50% discount. So the total of those is $2,000 for title insurance. So if I'm the buyer and I'm buying a title policy for the first, and then I'm the seller and I'm paying the buyers on the second closing, I could pay up to $2,092 just in the premium on these 2 closings. With a hold open, what I can do is I get the first one at $250,000, so that's $1,313. Then I do this hold open fee, which is really just the liability amount up to 110% of the purchase price. That's $34 in this case. So then I have my second closing, and I'm only paying the difference between the $250 and the $390, which is a really small amount, the $201. So I've saved like $500. So hold opens can be very useful. Here's the restriction on most of them. You have to sell it within a year. If you don't sell it within a year, you either need to renew it, which will cost you money, and might cost you $50 for another year. But if you don't renew it, then we will just issue the policy. And then, so if you're then sell it in another 6 months, you'd have to get the reissue rate. So you wouldn't have the savings. So that's how a hold open works. And every investor out there, when you buy a property, if you think you might be flipping it, get the hold open. And in this case, let's say I ended up keeping this property, Well, I only spent $34 more um, by not taking advantage of the hold open. But if I flipped it, I'm saving like $500. So a hold open policy can be really, really helpful.
Yeah, so there's a question here. They said they thought that the insured was for as long as it was with the same owner. So yeah,
Correct.
the insurance covers that amount of time, but what we're talking about here with the reissue rate and the hold open, these are discounts because in a way, there's less risk that something popped up in the 6 months, 12 months, 2 years, that these reissue rates or hold opens would apply, as opposed to somebody, who hasn't sold the property or transferred title in 20 years. Is that,
Right. Right.
am I close?
Yeah. So that I mean, you nailed it. So a reissue rate can apply in two different circumstances. One is maybe I'm getting a refinance,
Mm-hmm.
and since I already got a loan that was insured a couple of years ago, and now I'm refinancing, I'm going to get a discounted title premium because I'm refinancing within a certain period of time. Or I just bought this property from you last year, so I'm going to sell the property now, and I'm going to get cheaper title insurance because I've only owned it for a year. If I had owned it for 50 years, obviously there's more risk because there hasn't been any title companies looking at the transaction at that property, 50 years ago to today, at all, and so you
Mm-hmm.
got to do all that other research and make sure that there's just a much higher risk. So reissue rates are fantastic.
Yeah, I think I hadn't actually heard about the reissue rate, I don't think. So that's a great tip right there. And a hold open, I know a lot of people talk about it, but I think you actually putting an example to it really helped drives the point home. I mean, the prices you use there are pretty common prices today, and you can see a serious savings of $500. So that's real money in my eyes.
Definitely.
Well,
Yeah, definitely.
so we got one more question here. It says they're still confused. What's the difference from just keeping the first policy until you sell it? How is this better? I think they're talking about the reissue rate.
Yeah. So, okay, I'll break the reissue rate down. Let's say I bought my house 10 years ago. I've got title insurance. I don't need to then buy it again. I'm only the reissue rate only applies because I'm now selling my property, and the buyer wants me to buy the policy for them. So now that I'm transferring the property, I'm buying the policy for the buyer at a discounted rate because I've only owned my property for a couple of years. I hope I'm explaining it a little better.
Yeah, I think so. I mean, once you close and buy something, buy a property, then you get the title insurance, you have that insurance until
Correct.
you sell the property. So what we're talking
That's
about here
right.
is in the short term of buying a rental property and refinancing it, or a fix and flip and selling it. In the short term of it, when you have two closings and thus two title commitments, two title searches, all that in a short period of time, there's less risk in something changing in that time. So in my perspective, it's easier for the title company to do the research and diligence. There's less, you're not going through 50 years of information. You're only going through 5 months. And because of
Yep.
that, there should be a discount for that.
Yep. Exactly. Exactly. And
So,
different states have different discounts, and different title companies have different lengths of time for their reissues. It's kind of it's fairly competitive in Colorado. The rates are pretty much the same between most of the title companies. Some of the smaller ones like us are a little bit cheaper than the big guys, but then some of the other real small ones that do a lot of just lender business, they'll be even cheaper than us. So it's competitive because we can all see each other's rates. So nobody really prices themselves way out of the ballpark.
yeah, that's a good point. I mean, there's a lot of different title companies, and these are things you could shop for. You're going to get different prices at different places, but at the same time, I think as investors, it's really important for us to not be as worried about the price, but more concerned about how investor friendly are the title companies, how savvy are they, how many fix and flip investors do they work with, and wholesalers do they work with, and do they understand the ins and outs of working with investors. And for me, it's worth paying a little bit more to have someone like you, Greg, on staff there who is an investor, is a real estate agent, and understands all the moving parts that we as investors need to pay attention to.
Yeah, the good news is you don't even pay extra with us.
So here's a question. If you're holding the property and say you're doing a refinance, is there any need for a new owner's policy? So the owner is staying the same, but you're changing lenders.
Good question. There are some title products that have like an appreciation rider that will automatically appreciate. But if I bought a title policy for a tiny little bungalow in Highland, 30 years ago, I was probably insured for about $20,000. And if I didn't have some sort of appreciation, and now I wanted to get a loan to take some of that cash out, well, that property, it might be worth $700,000.
Mm-hmm.
So if I was concerned that something happened to the title that changed, I might say, you know what, I'm going to go ahead and get another owner's policy because I might be selling this thing in a few years anyway, and so I'll get a discount in the future. But I want to make sure to protect my investment now because the value's gone tremendously up. It's kind of like you insure your diamond ring for $1,000, and then the ring's now worth $10,000. You want to make sure that your insurance is adjusted accordingly. To be honest with you, it rarely ever happens where somebody comes and says, "Hey, I need a new title insurance."
Yeah.
Just really rarely happens, and I think it's because nobody knows what the heck title insurance is in the first place.
Well,
honestly, it's one of those things we go to close and we have no idea.
Hopefully after this hour with us, they're a little bit wiser when it comes to that. A couple more questions here. I know we're just over the hour, so thank you for everyone for sticking by and asking these great questions. We've got some more coming through here. If you need to jump off the line, we appreciate you joining us tonight, but there might be some more good questions if you got a couple more minutes to stick with us. Greg, here's one. In actually the slide that's up right now, $250,000 policy for 1313. So if you're getting a $500,000 policy, would that then be $2,600?
It doesn't grow incrementally in perfect increments like that, unfortunately. We have rate tables that the underwriters are the ones that set these rates, and so they usually go down as you get higher as far as the increment. So it's not going to be $10 each $1,000 of liability. It's going to be less. You know what I mean? So what you have to do is go to the title company and say, hey, I've got a $750,000 property. I need to know what it's going to be, and they can provide you with a rate table so you can see that, or they can provide you with a net sheet. Like if you go to our website at firstalliancetitle.com, you can do a net sheet on the website and see exactly how much it's going to cost you on title insurance.
Perfect. All right. Well, it looks like that's all the questions that we've got. If you want to jump ahead one slide so we can get your contact info one more time, Greg. And again, I'm Justin Cooper with Pine Financial Group. We're hard money lenders, and we'd love to chat with you about borrowing money. We're just doing deals or whatever the case may be. We'd love to talk real estate. So if you have any questions, feel free to reach out to us anytime, 303-835-4445. My email address is justin@pinefinancialgroup.com, and you can find us on the old interwebs at pinefinancialgroup.com. Thank you for spending some time with us tonight, and hopefully we'll be able to see you at some of the upcoming Success Summits. Greg, thanks for your time, and have a great night.
Thank you. You too. Bye-bye.